morning, everyone, and welcome to our public webinar. We thank you for joining us on this lovely Saturday, and we have many participants attending today from on Zoom. The bandwidth might be stretched because of the volume of participants, so we apologize in advance for any lag or delay you experience. I'm Ashley Fu, and I'll be your host and moderator for today. As the Russian-Ukraine conflict continues, amidst the rising interest rate environment, how should investors position their portfolios during this period of transition? Countries are gradually opening their borders to international travel, but will this be enough to boost their economies? What does this spell for the outlook on inflation and risk assets in the second quarter of 2022? To help us answer some of these questions today, we're joined by the key investment team of Affin Hwang Asset Management, including Esther Teo, Senior Director of Fixed Income, and Khoo Hsien Liang, Portfolio Manager of Equities. Together, we'll unpack the outlook for the next quarter of 2022 and how the team is navigating the market landscape. Before I pass it over to our first speaker, there is a Q&A session at the end of today's forum. Please feel free to type your questions and submit them via the Zoom Q&A box. You can also click like to upvote questions to the top. Now, let me pass the spotlight to Khoo, Equity Portfolio Manager.
Hi, morning everyone. It's so good to virtually see all of you coming to listen to us on a Saturday morning. So I really appreciate the time that you've taken. So anyway, without any further ado, the presentation today by both Esther and me would be on the war, the Federal Reserve and the market. So let's go to the next slide. All right, so just quickly before we start on equities, this is just the asset class quilt of returns, just to show you where we stand in terms of different asset class returns. So this table that you see here is as at 10th of March, but generally it's still more or less the same. So for year to date, what we are seeing is that commodities has really been the outperformer for this year. It's up around 26% year to date, as well as gold, which is up around 5%. And this is quite a classic case of where there is high inflation, as well as concerns on the market, where you see high inflation pushing commodity prices up, as well as uncertainty, which is pushing gold up. All right, thank you. So let's go to the next slide. Okay, so for the equities market outlook, this would take probably around 20 minutes. And then after that will be fixed income, and then followed by Q&A, which we'll be more than happy to take more questions. I want to just kick off this first slide since there's a conflict going on, and it's been dominating the news for the past 2 weeks. Should we buy the dip and should we buy at the sound of cannons, right? So there's a famous saying by Rothschild, buy when there's blood on the streets. So over here, I just want to show you about how has the market performance been over the last century during conflicts. So on the left, you can see in the first chart, figure 1, this is S&P 500 performance over the last century. And then you can see the individual gray bars. Those are actually the major conflicts that we saw in the world. So there was like World War I, World War II, Korean War, Vietnam War, etc. So you can see that on general, the market actually, in past wars, the market tends to have a sharp sell-off, which ended before the war itself, and the market actually recoups all losses before the war ended. And I actually saw in another table that's not over here, that the average return that someone can get when you invest after a conflict within 12 months of a conflict is around 10+%. So on average, it does make sense to buy during conflict, does make sense to buy at the sound of cannons, but I would like to highlight there are exceptions to this rule. So if you can see on figure 2 on the chart on the right, that's actually the S&P 500 before and after the Yom Kippur War of 1973, okay? So the 1973 crisis actually started when Israel was invaded by the neighboring Arab countries. And what resulted after that was actually an oil embargo on the US, as well as a lot of countries that were supporting Israel. So what we saw was that in this conflict, the market actually corrected by 48% and actually took several years to recover. And the reason why we would like to highlight this particular conflict is that there are similarities between this 1970s conflict as well as what's going on in Russia and Ukraine, because we are seeing an increase in oil prices, inflation, as well as similar in 1970s, the Fed was also hiking rates as well, which was what we saw in 1970s. So we would like to just put some caution that yes, on average, buy when at the sound of cannons, but in this particular conflict, it does appear to have similarities to 1970s, where it takes a while for markets to recover. Let's go on to the next slide, please. All right, so just an update on the situation in Ukraine. This map that you see is actually as at 14th of March. So you can see in the yellow star over there, that's the capital of Ukraine, which is Kiev. So Kiev is still under attack, but still holding out. And I would like to highlight in the map also, there's this little purple triangle at the bottom called Odessa. So you can see that the most of southern Ukraine has actually been taken by Russia, except for this last remaining port, which is the port of Odessa. And the reason why I want to highlight this is that 90% of Ukraine grain exports go through the ports in the south. And if the Russians manage to capture the port of Odessa, Ukraine will have great difficulty in exporting their grains in the future if they continue to remain independent. There are three observations that I would like to share from this conflict so far. So I entitled it a slower, stronger, and sharper. So number one is that the Russian invasion is much slower than expected. So first of all, we were surprised by the invasion. So for myself, I thought Putin was bluffing, but his invasion actually did take place. But when the invasion started, most analysts, we all thought that this conflict would take 2 to 3 days, right? So I think the conflict was on Friday or Thursday. We thought that over the weekend, Kiev would fall. But actually, it turned out that the Russian army was not as well prepared as we all thought they were. So they're using conscripts, meaning people who are not professional soldiers. The Russian military hasn't been able to control the air. So even though they've upgraded their air force, which we thought they would dominate the skies, they have failed to dominate the skies. And then we see a lot of different news about Russian tanks, Russian trucks being ambushed continually, as well as being stuck in the mud. So the Russian invasion is much slower than expected. The second part, actually, Ukrainian resistance is also much stronger than expected. So we've seen that a lot of people thought that, the Ukrainians, they would buckle in, Zelensky, he's a comedian by training in the past. So they thought that, this guy is just joking around. But actually, it turns out that, Zelensky has managed to turn himself around to be a very exemplary wartime leader, as well as the Ukrainians are being armed to the teeth by a lot of weaponry by NATO and the West. So they've got like anti-tank missiles, anti-aircraft missiles that have actually proved to be very potent against the Russian military that was not prepared for this. And the third observation that I have to highlight is actually Western sanctions. They are a lot sharper than all of us expected. So if you look at leading up to this crisis, previous sanctions were a walk in the park. So if you saw back in 2014 when Russia annexed Crimea, the sanctions that we saw were individual based, right? So, okay, minister so-and-so, we sanction you. You cannot open an account in Europe or a US bank, right? So it was just individual based, a few sanctions here and there. So everyone thought it would be the same thing. US probably would sanction like, Lavrov, Putin, right? So we all were expecting that. But what the West did this time was quite remarkable and unprecedented. So the one that I would like to highlight was actually what they did to the Russian central bank reserves. The Russian central bank has been accumulating FX reserves for the past years after the Crimean crisis, and the reserves were around 600 billion plus. Yes, there's a portion of it in gold, but a lot of it is actually in FX reserves that is held in corresponding banks. So they're actually held in like banks in Germany, in Japan. So what happened was that the FX reserves were effectively shut off, all right? It was effectively frozen. So imagine one day you wake up and you go to the bank and the bank says, yes, we see that you have money in our bank, but you cannot withdraw it. So that's actually what happened to the Russian central bank. And this is, I would say, unprecedented. The previous time that US did it was against Afghanistan, right? So when the Taliban took over Kabul, they froze the Afghanistan's gold reserves. Afghanistan is one of the poorest economies in the world, but Russia is the 11th largest economy in the world. So when they actually decided to clamp down on their reserves, this was actually very surprising. And so in terms of sanctions, all right? So three things: slower than expected, stronger than expected, and sharper than expected. Let's go on to the next slide, please. All right, so what does this mean in terms of the effects around us, all right? So first and foremost, when the conflict started, a lot of people say, this is a small thing, right? So Russia, Ukraine, combined global GDP is around 3.5%, a small amount. But what we realize is that as we dig into the details, there's actually a bigger effect. And the main reason why is that Russia and Ukraine play a very important role in supplying key raw material and commodities around the world. All right. So if you see in this chart here, Russia and Ukraine, Russia provides 27% of global palladium. And if you look at it in terms of grains, foodstuff, wheat, barley, corn, all of these things are actually key components of global supply that is supplied by Russia and Ukraine around the world. At the same time, not to mention, there's also gas and oil as well, of which Russia is the second and third largest producer of natural gas and oil in the world. And this will have great ramifications to the commodities complex. And we've already seen that in terms of the prices of like wheat that is up 30%, soy, and even oil is all up like really sharply. Okay, yes, it has come down, but year to date, it's still up quite a fair bit. Let's go to the next slide. The second effect is actually on supply chains, all right? So on the left chart on figure 5, we've seen that ship counts have dropped sharply across all major ports in Russia and Ukraine. There's no surprise because there's a conflict going on. And this, the drop in ships is actually across all different types of vessels. So if you see on figure 6 on the right, we are seeing a drop in like containers, oil tankers, dry bulkers, so things that basically transport oil, transport commodities. There's a big sharp drop off. All right, and the reason why this is important is if you recall, after COVID, the world was actually struggling with supply chains, right? So there was supply chains problems even in last year, and now starting of the year, there were already supply chain issues, and this thing will further exacerbate supply chain problems that we are seeing around the world. I can go to the next slide. Ultimately, what this translates into is actually inflation. Okay, so we are seeing right now for US CPI, I believe it's around 7+% to 8. It's actually really running hot in terms of inflation, and this conflict ultimately will boil into inflation, right? So if you can see here on the chart, this is just some sensitivity tests just on oil price. So if like oil is at 150, CPI is expected to be around 7.7%, and then if it, God forbid, hits $200, then CPI will actually reach 9+%. So ultimately, this feeds into inflation. Next slide, please. All right, and to top it all off, because of high inflation, we've seen that the Federal Reserve is actually hawkish. So in their latest meeting, they've actually hiked rates by 25 basis points, and then they're expected to hike 7 times in total this year. This part, I think I'll let Esther elaborate more on later. But the main takeaway is that when the Federal Reserve is hiking rates, it is a continued headwinds to equity markets as our cash flows are discounted to the risk-free rate. Let's go to the next slide. All right, so without any surprises, because of the high inflation as well as the Federal Reserve hiking rates and global central banks hiking rates, what this means for equities is that there's a very big dramatic shift in styles. So what we are seeing is that growth stocks have been selling off, and there's a big shift to value. And growth stocks are expected to continue to struggle in an environment of rising rates. All right, so when we say growth stocks, a lot of this that we've seen is companies that have a very high revenue growth, but almost zero to no profit. All right, so last time when rates are zero, investors are willing to invest in high growth stocks because rates are zero. We are willing to look far ahead into the future for future cash flows for you to turn into a profit. But right now, when rates are rising, investors are like, hey, I might as well put in risk-free rate rather than put a bet on a company that may or may not return profit in down the road. And let's go to the next slide. All right, so we've talked about the Russian-Ukraine crisis. We've talked about inflation and the Fed. So now I just want to talk a bit about China, what's going on, the largest economy in Asia. So what we're seeing is that for China, there's also headwinds. On the chart on the left, you can see that the property sector is still struggling. This is a combination of a lot of tighter regulations, the 3 red lines on property market. So you can see that the property sales are still trending, are still on the declining trend. So that's one. And number 2 is that exports, even though they are doing very well, what we are concerned about is that exports could slow due to a global slowdown that is stemming from the Russia-Ukraine crisis. Let's go to the next chart. All right, but the good news is that China is easing. So we saw that in their latest NPC meeting that China has come out to say that they are targeting 5.5% GDP growth around there. And also that the NPC has also reassured the return of fiscal and monetary impulse. So what this means is that even as the world is tightening, as the Federal Reserve is tightening rates, China is looking to loosen the economy, maybe cut rates and do more fiscal stimulus to keep the economy going. So this will actually be supportive for China. Let's go to the next slide. The wild card right now is actually COVID, all right? So we've seen there's been a sharp rise in COVID cases in China again. And China is still adopting a zero COVID strategy, meaning they're saying that we will not accept any COVID cases. But there's a little bit of nuance as you see what China is doing now versus what they did back in February 2020. So if you see in the chart on the right, back in the early stage when COVID first came out, what we saw is that China was very strict in all their lockdowns. So you can see the chart on the right, the blue and yellow line, service production and exports actually dropped sharply in the first round of lockdowns. But then what you notice is that as the different COVID waves came across, so the next one was the winter resurgence, and then the last one was Delta variant, we noticed that Chinese exports and services managed to hold up. And the main reason why is that China has started to change their strategy. Rather than lock down the whole country or lock down somewhere for a very long time, what they're doing now is they're doing very targeted lockdowns. Like, okay, this area there's COVID cases, let's lock down, test everyone, move on to the next area. And in the latest announcement that we are seeing in China, they're starting to be a little bit more relaxed, all right? So you can see in terms of the media positioning, last time they'll say that, oh, COVID is very bad, it's going to kill you. Right now, they're starting to change their tune, saying that, okay, we can start to live with COVID pandemic. They're introducing antiviral drugs from Pfizer. At the same time, they've also shortened the quarantine period from 14 days to 7 days for people who is home quarantine. So things are starting to change a bit. It's not a big shift like what we're seeing in Malaysia where everyone's going out to shopping center, don't care already. But what we're seeing now in China is that they're taking baby steps to start to accept COVID as a reality, which is in the end good for the economy. Let's go to the next slide. All right, so we've moved from China to now earnings. So earnings expectations have deteriorated. What I'm saying is that earnings are still positive, still growing, but the growth rate is slowing as well as the beat rate. Okay, so the percentage of companies that are beating expectations are dropping. And one thing that we are starting to look out for is actually when companies report their first quarter earnings next month. All right, so let's bear in mind that a lot of expectations are for like mid to high single digits earnings growth, but this is all before the Russia-Ukraine crisis. So there is some expectations that as companies start to report and guide for 2022, we might see more margin compression coming from commodity prices as well as supply chain issues. Let's go to the next slide. All right, and to top it off, as I mentioned earlier, the Federal Reserve is hiking rates. And typically speaking, during a period of hiking rates, there is more volatility in terms of share price performance. So you can see both in the S&P 500, sectors will struggle to see their multiple expand during a period of Fed rate hikes, as well in Asia where stocks tend to derate ahead of the first Fed rate hikes. So the takeaway here is that there'll be more volatility in equities. And let's go to the next slide. All right, but all in, valuations do look compelling. So over here, this chart is as at 13th of March 2022. So we've seen that MSCI China, MSCI Asia, ex-Japan, the multiples have come off a fair bit, around 10 to 11 times PE, forward PE. So the valuations do look very compelling compared to what we saw last year. Next slide. All right, and in terms of sentiments, so this is actually a contrarian indicator, right? So this contrarian indicator, the main message is that the more bearish market is, the more you would want to buy the market, right? Because it's a contrarian indicator. So what we are seeing right now is that the indicator is at 2.9. It's coming close to extreme bearish, but not yet. But it's actually starting to show us a good buy signal coming. Let's go to the next slide. All right, so the main takeaways from my presentation will be number one is that the environment for equities is challenging, giving rising rates, slowing growth, and also earnings expectations that would most likely come down. And earlier on, when I talked about the Russia-Ukraine crisis, the main message is that the longer the conflict takes, we are starting to deal with more unknowns. So like as the conflict prolongs, will we see more sanctions? Will we see more unexpected events in the conflict? We are exposed to more black swan events. So it's something that we have to be on the lookout for. And as well as history is suggesting that there is a bit more downside because when the Federal Reserve, they call it the put option, that's no longer there because they're hiking rates due to high inflation. Sentiment indicators are turning bearish, but we have not yet seen extreme panic yet. So in terms of our portfolio strategy, we already have decent cash buffers around 30+%, and we are deciding to stay defensive for now. The two main indicators that we're looking for is number one, a peace agreement between Russia and Ukraine. We've been seeing different news and market has been responding positively to it, but any more concrete news would be even better for the market. As well as number two, central banks turning more dovish. So if the central bank down the road decides to say, okay, we're going to pause rate hikes, we're going to pause quantitative tightening, this will be extremely bullish for equities. So yeah, that concludes my equity presentation. I'll hand it back to the MC to take it from there. Thank you very much.
Thank you, Khoo, for the insightful presentation. Up next, we have Senior Director of Fixed Income, Esther Teo.
And good morning, everyone. Yeah, today I think we are going to go through the fixed income outlook after Khoo's very insightful presentation. Here I have a table of total returns ranking across different fixed income markets over the last decade. So there's a few points that I want to make here. Is that over the years, fixed income generally will give you positive returns. But you can see here that, there are certain years once in a while where, fixed income can give you some negative returns, like back in 2013, back in 2018, and the current episode that we are seeing year to date, where across all fixed income assets are giving negative returns, right? So as you know, fixed income is very sensitive to interest rates outlook, which is very much tied to macroeconomics and inflation outlook. And maybe I can just go back and talk about 2013, 2018, why fixed income were giving some negative returns in those episodes were because the Federal Reserve were looking at tightening QE, the QE program that they have in place, or they were in a hiking interest rates cycle. So that's point number one. Point number two is that generally, if you look at the year after a negative returns in fixed income, you have a very strong recovery. So back in 2014, you can see that across various fixed income asset class, they are giving you high single digit to even double digits returns. And also back in 2019, we also saw that most fixed income sectors give you double digit returns or high single digits. So would it be the same for next year? Time will tell. But what I can say is that the sell-off in 2022 is the sharpest that we have seen since the 2008 crisis. And that tells me that bond yields are correcting very sharply. And we could see a stronger returns in 2023 when markets stabilize. But we will go through some of the things that you are looking at and what we expect in the next slides. So I think Khoo has spoke quite a little bit about inflation, and I won't go through that again, but you can see that inflation is really spiking. And I just want to highlight on the chart on the right side is that inflation has already been rising back in 2021 before the Ukraine crisis, right? And you can see that if you break it down, it really contributes from both the supply constraint as well as demand, a strong demand. And this is really because of the COVID-19 pandemic. We have seen a lot of supply disruptions that cause inflation spikes. For example, what we are seeing in the auto sector in the US, and also high commodity prices driven by supply constraint, as well as a strong return of demand as the global economies reopen after the pandemic back in 2020. So the component of the CPI, is quite broad-based, and that's the reason why the Federal Reserve is determined to hike interest rates to try to bring down the inflation expectation. And the ongoing Ukraine-Russia conflict just adds another layer of complication to the Federal Reserve and other central banks, because that means that they have to continue on their path of hiking. Even though the outlook of growth is very uncertain, and there could be potential downside risks to growth due to the ongoing conflict. Okay, next. Besides hiking rates that we are expecting the developed market central banks to play catch up now, I just want to highlight that on the chart on the right side, is that in fact, a lot of emerging markets countries, especially in Latin America, has already started hiking interest rates back in 2021. This can be seen in the green bars that is the emerging market central banks. Whereas the blue bars are, the developed market central banks, they have really just started the rate hike cycle. So we do think that the emerging market central banks are ahead of the curve, where they can end their rate hike cycle sooner compared to the developed market central banks who are just getting started. So just now, Khoo mentioned that the Federal Reserve is expected to hike interest rate by 7 times this year at 25 basis points. That will bring your overnight rate to around 1.5 to 1.75%, whereas there is also the expectation that the Federal Reserve could even hike 50 basis points in this year if the inflation numbers continue to be strong. Another thing that we want to look out for is the central bank balance sheet. On the chart on the left, what is this central bank balance sheet? Is that how much assets they hold, right? So central banks, after the 2008 crisis, I'm sure you have heard of what we call QE, or quantitative easing. That is really, the central banks printing money to buy into financial assets such as treasuries, mortgage-backed securities, and that helps to provide liquidity into the financial markets and the economy. And over the last decade, you can see that after the GFC, they have done 3 times QE 1, 2, and 3 back in 2008, 2010, and 2012. But look at that huge mountain up there. The last crisis in 2008, the central bank's balance sheet has been growing from below 1 trillion to around 4 trillion at the peak. But what really pushed up the central bank's balance sheet was during the COVID-19 pandemic back in 2020, where central banks went on a bazooka, printing money, and the balance sheet of the large 4 central banks here that we saw has grown from about 4 trillion to close to $10 trillion today. And this is why you can hear that many of these central banks are saying that, hey, it is time to bring down this balance sheet, to reduce the size of the balance sheet, because it is just not sustainable. So on top of the rate hikes that we are seeing this year, I think the Federal Reserve as well as the European central banks are looking to reduce their balance sheet, which means they are going to buy less US treasuries or bonds in the market and let the balance sheet falls from here, right? So what is the impact on the bond market? When you have central banks buying bonds in the market, it means that the demand for bonds is always supported by central banks. But when the central banks are saying that they're going to ease off the buying, it means that the support on this bond demand is going to be weakening. So hence you are seeing that adjustment in bond yields and the correction that we're seeing since middle of last year until now. This has already taken place, even though the actual tightening has not even started. So what does this all mean on the outlook? So yes, we are expecting 7 interest rate hikes this year. We are expecting the Federal Reserve as well as ECB to tighten their balance sheet. But what I want to caution is that a lot of this has already been priced in by the bond market, because bond yields have already started the correction since early 2021, right? So unless we think that the Federal Reserve have to hike even more than 7 times this year and even more tightening than what the market expect, we think the sell-off in the bond market is largely priced in. Of course, the Ukraine war adds a layer of uncertainty, as we mentioned. If it can be concluded, if a peace talk can be concluded within the next few days or weeks, then I think it will be more positive for the markets, because I think that means that oil price could really come down, commodity prices can come down, but it would not come down in a big way over the short term as well. But at least we were likely to see a peak in that commodity cycle. So we are watching this closely. Next, we just want to talk about China. Just now, Khoo already talked about China. That is one of the few major central banks that are going the other way, where they are cutting interest rates and being more stimulus. And because there has been a lot of headwinds in the economy in China. Right, so I think for the fixed income market, what I really want to focus on is on the property sector, because the China property developer, contributes more than 50% of the China high yield market in Asia, and it is a huge component of Asian bonds. And if you remember last year, there has been a lot of headlines about a default by Evergrande, and I think at that time, the market thought that it is a single event, because Evergrande is the world's most indebted property developer in the world, and it was kind of expected that they will run into trouble. But what the market did not expect is the contagion that it has caused, that we are seeing the effect now in 2022. So in the next page, we just want to touch about the property sector, where, after the default of Evergrande, what happened is there has been a loss of confidence on Chinese home buyers on the whole sector, because they are concerned about delivery of projects as well as the survivable of the other developers. So home sales in China have dropped significantly since last quarter, where home sales have dropped 40 to 50% on a year-on-year basis. And of course, the average selling price have also been declining. And this has a major impact on other developers that relies on property sales for their cash flow. At the same time, the bond market and the loan market has been extremely tight and very difficult for developers to access funding in the current environment. The high yield sector has sold off significantly, and as well as most of the high yield bonds in the China property now are trading above 25 to 30% yield. This has never been seen before in the China property sector, and you're trading at yields that are signaling that default risk is very, very high. So I think at this point, the government is aware and they have to do something to stabilize the whole market, because the property sector contributes about 30 to 40% of the China GDP growth. I think what was a surprise to many investors, including ourselves, is the speed where the government is acting on this. We expected them to act a lot faster to contain the spread of this contagion, but they were pretty slow to react. The policies that have been announced include cutting interest rates, encouraging central SOEs or state-owned enterprise to help the property developers, or asking banks to give loans to them. But all these are not enough, because the banks are still very cautious. So unless the government give them instruction, they are not going to act in a major way. But I think the good news is coming. As of last week, given the very sharp sell-off we saw in both the China stock market as well as the property market in the bond sector, finally the government came out to say that they will prioritize fiscal and monetary stimulus to ensure that the financial market stability is there, and they also want to achieve their GDP target for 2022. So I think in second quarter, we will see a lot more concrete move by the government, and we think the bottom of the bond yields sell-off is nearing. Okay, next. Okay, now let's just talk a little bit about bond valuation, right? So just now I mentioned that over the last decade, we have seen a number of QE embarked by central banks, where they're buying a lot of bonds from the market. And given the size of this buying, a lot of these bonds have turned negative yield. That means that especially in Europe and Japan, if you're buying these bonds, they are giving you negative yields, which is really a very unprecedented scenario. At the peak, we have about 18 trillion of bonds in the market that are trading at negative yields. But fortunately, with the rise in interest rates that we are seeing since 2021, this trend is reversing. And currently, we have only $4 trillion of global bonds trading at negative territory. What I want to highlight is that bonds are looking more attractive. But of course, in Affin Hwang, we do not invest in all these negative yielding bonds. We prefer to stick to bonds that give you actual positive returns. Whereas, I think investors in Europe and Japan are really in the struggling position because their bonds are still trading at very low yields. So on the chart on the right, that is the actual bond yields that we can get if we are invested in US investment grade, which is in the blue line, or Asian investment grade, or European investment grade bonds. What you're seeing here is that bond yields are rising since 2021. And we welcome this move because as a long-term investors, it means that, if you are putting your money in, you will be at a higher yield. So just about, in August 2021, at the peak of the bond market or the lowest point of bond yields, you can see that if you are buying into the US investment grade or Asian investment grade, you are getting a return of around 2%, but today you can get a return of over 3%. Yeah, so bond yields are actually looking more attractive, and we believe that in the second half of this year, there are a lot of emerging opportunities to go back into the market. And lastly, okay, this is another chart to show Asian bonds versus US bonds. And it is very clear that, in the high yield sector, like the chart on the right side, on the bottom, figure 37, the high yield space in China property has sold off significantly, and hence, there's a lot of very attractive valuation, but we are still very cautious, looking at very, very selective names in that sector because the default risk has risen given the factors that I mentioned earlier. But definitely Asia is looking more attractive on the high yield space, whereas on the investment grade bonds, the high quality bonds, both the market has also giving decent yields now. And lastly, I just want to talk about the supply on the next slide. So another thing that we, okay, I think I'll skip this one. The other thing that drive bond prices, is on technicals or how much supply and demand are coming out. So you can see that since the correction takes place in 2021, as well as year to date 2022, it has been very extremely low supply of bonds coming to the market. And that is a positive signal because that means that, a lot of bond maturities are going to take place in 2022, given if you look back in the last few years, 2017, there was a very high net issuance back at 5 years ago. And since most bonds are issued around 3 to 5 years maturities, there's a lot of bonds that will mature this year, which means this money has to be reinvested. At the same time, there's no new supply coming through. That means that demand for bonds will be stronger in the next few months for the rest of this year as well. So I just want to conclude on our strategy is that, the takeaway from this is that we think the Federal Reserve, as well as other central banks in the developed markets, will continue to hike interest rates, even though there is a lot of uncertainty on growth outlook due to the high inflation, right? So, but like I mentioned, a lot of the bond yields have adjusted and priced in a lot of rate hikes already. So we think that, bond yields are unlikely to go up a lot more from here. And we also believe that growth is going to slow down. Just now, Khoo talked about, the earnings outlook as well. It's also a reflection that economic growth is slowing down from a very high base last year. That is another reason why bond yields cannot rise too significantly. And there is also a potential that if the Ukraine-Russia conflict continue to drag and the impact on growth is a lot more significant, then these central banks could pause or even reverse their stance later part of that year. On the China property sector, as I mentioned, more urgent and material policy response is needed to turn around and prevent further contagion. I think the default risk in this sector has increased tremendously, but the government is taking notice now, and they know that it's important for them to make sure that it does not spread to even the strong property developers. So on our strategy part, we are staying cautious given that interest rate hikes is taking place. So we have been holding high level of cash. Our cash level in our key funds is now around 15 to 20%. And we are holding a lot of short-dated bonds in our portfolios. In general, our duration on the funds are around 2 to 3 years for our global and Asian bond funds. And we are seeing some pockets of opportunities emerging after the sell-off that we have seen, especially in the investment grade space. The China tech sector has corrected quite sharply due to the recent regulatory risk. State-owned enterprise, especially in property developers. And the two emerging markets that we like currently is Indonesia and Malaysia, given that we are commodity exporters and we are seeing a lot of inflows into the bond market. And we think that, given that this year, a lot less withdrawal from the EPF scheme, although the government has just announced a new one of allowing members to take up 10,000 ringgit. But I think the major withdrawal of 110 billion last year has already taken place. We do not expect a major impact on the recent EPF withdrawal scheme. We also believe that Asian central banks, such as Indonesia and Malaysia, will be a lot more patient in hiking interest rates. So, in March, we saw that both Bank Negara and Bank Indonesia did not hike interest rates because our inflation is still within the range of 2 to 3%. And one of the reasons why the Asian central banks are able to afford this is because, in a lot of these Asian countries, our inflation numbers is low because we do have quite a lot of subsidies by the government, and that is keeping a cap on inflation outlook. And on China, the property sector is having a lot of problems, and that is causing the China government having to cut interest rates to stimulate growth. And hence, we are bullish on the China government bonds. It's one of the few sectors that we think are still giving good value, and it could give you potential capital gains. As well as the Malaysian MGS market, because the Malaysian market has been pricing in around 3 to 4 rate hikes in Malaysia, which we believe Bank Negara is unlikely to do so much rate hikes in Malaysia. Where we are underweight is, of course, the developed markets government bonds, given that they are still at the start of the rate hike cycle. So we do not hold any of these treasury bonds. So on high yield, China property developers, because of the valuation after the sell-off. But as I mentioned, we will be very, very selective on these names when we want to make sure that the government comes in with more policies before we deploy more money into this sector. So that concludes my presentation for today. I'll pass it back to Ashley and we can go on to Q&A. Thank you.
That was a very interesting presentation. I hope you guys are taking notes because I am. Thank you, Esther, for the enlightening session. Right, so we have come to the Q&A session of today's webinar. Thank you to those who have submitted your question. And we have received quite a few questions from you guys. But due to time constraints, we will just be choosing just a few questions to address. Right, so here's the first question. How should investors position gold in their portfolio? So as you see, as the markets are uncertain, this is not for Esther. How would you recommend gold as an ideal hedge of inflation? Is gold at its peak? Would you consider crypto as an alternative?
Thanks for the question. I think it is clear that just now when Khoo showed on the slide, the first slide that we have, that commodities as well as gold has been the top performer this year. And this is a very typical, response, right? When there's inflation and risk-off environment, a lot of uncertainty, gold tend to outperform. And in the current environment, commodities as well, we are seeing, especially energy prices, has been doing very, very well. So should investors hold gold in their portfolio? I think that is a very personal preference as well. So I think definitely in the short term, gold is a good hedge given the inflation outlook. But of course, gold has also rallied quite a lot. And it could be subject to correction if, let's say, the Ukraine conflict has a good solution to that, then you could see some pullback of gold prices. Another thing to note about gold is that it does not provide you any income, right? It's mainly just holding it on capital appreciation, but gold itself do not give you any capital, any income as you hold it. Yeah. And crypto, we do not actually invest in crypto in our firm, and personally as well, I don't. And I think what we have noticed on crypto is that the correlation with crypto and the global liquidity is quite high, which means that it is more a risk-on assets. And when people think that there's a lot of liquidity in the market, they want to go into crypto as well. But now we are seeing a withdrawal of liquidity from the market. Will be quite volatile and may see some pullback from there as well. But I must admit, I'm not an expert in crypto. Yeah, and I would say that it is a very, very volatile asset class. If you do want to, get your hands into crypto, just be prepared for the volatility, and you need to be quick in your trading stance as well.
All right, thank you, Esther. So the next question, this one's from John. Do you expect any policy from the government or Bank Negara in views of higher inflation? So I guess Khoo can take this one.
Sorry, maybe Esther, I think this one would be more.
Okay. Yeah, I think Bank Negara, in March held the interest rate steady as expected by the market. And yes, I think inflation in Malaysia will creep up as well. We are not totally isolated from what's happening. I think if you go out shopping, you can see that, your bills on your shopping has been increasing as well. So definitely inflation is going to creep up in Malaysia. But I think the pace of the inflation in Malaysia is going to be kept because of the component of the CPI baskets, and also the subsidies that we see, that we have in many of the items, whether it is our fuel price or our food price, the key basic food items. But we do think that inflation is going to creep up in Malaysia, and hence we do think that Bank Negara will have at least maybe about 2 hikes in Malaysia this year. But I think in the recent meeting, from their outlook, they are focusing more on the uncertainty caused by the Ukraine conflict. They are more worried about the downside risk, and they have not revised their inflation numbers. But we do expect that, by end of the month, they should come up with some new revision, and we expect that inflation will be slightly higher. But our inflation numbers is unlikely to hit what we are seeing in the West, like what the US is seeing at around 8%, because in those countries, the fuel price is 100% passed through to consumers, whereas our petrol price is still at 2 ringgit, whereas, in the Western countries, they are paying the full price for a lot of these items. Yeah. So I hope that answered the question. So we expect 2 hikes in Malaysia.
All right, then. Thank you, Esther, for sharing your view on it. Okay, so this one's for Khoo. What was the main driver for the surge in China equities last week? Do you think it's sustainable?
Okay, thanks for the question. That's a really tricky one. So just a recap for those who are not aware. So on Monday and Tuesday, the markets were really tanking, and then what changed and caused a very sharp rebound was actually Liu He. He actually came out to make a very unexpected announcement. So he said a few things. Number one, he said that the property tax trial will not be launched this year. Then he said monetary policy needs to be more proactive to increase credit growth. And then he also said that the US and China are making progress because there was actually talk about ADR delistings in US. So he says that US and China actually now engaged in talks to resolve this problem. As well as he also said that there's going to be a regulatory reset for big tech in China, where it's going to be more transparent and more predictable, and basically it's telling the ministries that you cannot just unilaterally come out and say something that will hit the markets, but you need to coordinate with other ministries. So net, this is definitely positive for markets. So you can see the sharp rebound. Is the rebound sustainable? I would say no. I mean, I would not expect a 20% spike like what we saw on Wednesday and Thursday, because that kind of move is too sharp. You cannot expect that to continue. Net is positive, but at the same time, I think the devil is in the details. So while he made a lot of good announcements, all of us will have to watch out for further details for all of the things he said.
Thank you so much for sharing that, Khoo. All right, so I have another one for you. Are we expecting more regulations from China, or is the worst over?
All right, so earlier on I mentioned what Liu He said. So what we are expecting is that there will be more regulations coming for sure. But what we expect is that the regulations won't be as scary and sharp as what we saw last year, where out of the blue, you just get hit. So we're expecting to, when the announcements come, it should be more gradual, more transparent, and less shocking. So net, it should be positive.
So just now earlier, we talked about inflation. So this one's also for Khoo. So speaking on hedges for inflation, many consider REITs as a hedge for inflation. What is your outlook on REITs, particularly in Singapore?
Okay, so a few things. Number one, REITs are yielding instruments. So when in a rising rate environment, it would be a headwind to REITs, right? Because they are yielding instrument. So that's number one. But number two, REITs are unique in the sense of REITs are essentially landlords, right? So when there's inflation and economic growth, landlords will eventually increase the rent. So we see that phenomenon for offices, for shopping centers, for industrial properties. So in the long term, when yields start to stabilize and inflation remains slightly above trend, that will actually be ultimately good for REITs, because as landlords, they will increase the rent, which will increase distributions, which will help unit holders. In terms of outlook for Singapore, we like the retail and office space. We believe that Singapore is very unique in the sense of the government has a very good handle of what's going on in the country for COVID, as well as Singapore is becoming a very important office hub as people relocate from Hong Kong and tech companies want to relocate to Singapore. So we like the office and retail space in Singapore.
All right. And on that, this one's for Esther. As we see more defaults in the Chinese property sector, are we expecting more government support and a possible recovery from here?
Yeah, definitely. I think following up from what Khoo mentioned, the government also mentioned about the property sector, and that is positive. Earlier, I mentioned that, we were surprised that they have taken quite long to come up with these policies. And even now they have lacked details. But some of the things that we think is positive, for example, is that they are using some of their asset management companies in China. They are issuing bonds to help the property developers. So indirectly, that is giving funding where the other funding market, like the bonds and loan markets, are shut. So this is one avenue. Another thing that they're doing is that working with the state-owned enterprise to buy over some projects from these developers, and that will inject cash into the property developers as well. And we do expect asset sales as well by the developers. So what we want to see is more solid and details of these policies that they are announcing, which I think it will be forthcoming in the second quarter of this year. So yes, we do expect more policy response to help the developers, because at this point in time, even the strong developers are seeing their bond prices trading at very distressed levels. It does not reflect the fundamentals. And what is more concerning is that if property sales continue to spiral downwards, the impact on the whole China growth outlook will be very severe as well.
All right, thank you, Esther. So now we are taking our last question. So this one's for the both of you. Should we focus on safe haven or risky assets going into 2022? Maybe Khoo wanna go first?
Well, in hindsight, I wish it was 100% safe haven at the start. But I think the way I will approach this question is actually two things. Number one is your risk tolerance and your time horizon. So if your risk tolerance is very low, like you cannot take risks, you're very scared, you see the market, you panic, then I would please go to more safe haven. But if you can take more risk and your time horizon is long, then actually this is a good opportunity to go into risky assets. When I say risky assets, I'm talking about like maybe equities, not crypto. And even within like the equity space, you can diversify your portfolio. You can buy a mixed bag of aggressive stocks, defensive stocks, just to hedge things out. So net, it depends on your risk tolerance, your time horizon, and please be diversified.
Okay, and Esther, what about you?
Yeah, I think definitely it has been a very challenging year, right? Besides commodities and gold, other asset classes have registered negative returns. But I think what is perhaps encouraging is that we are only in March. The market has sold off significantly. We have seen sharp corrections in both equity and bonds. But is it time to go all in? I think it is not. It is time to relook at a portfolio. But in terms of putting money into the market, I think you have to do it gradually, given that there's still a lot of uncertainties, right? But it is not a bad timing because valuation today is a lot more attractive compared to 6 months ago for both equity and bonds. And I think for risk-free assets, if you're talking about treasuries, for example, or government bonds, then you have to be selective as well on which market we are looking into. So I think earlier I mentioned that emerging markets, there have been a lot of rate hikes in Latin America. So some of these, what I would say that the yields on those bonds are a lot more attractive, whereas the developed countries are just starting out on their rate hike cycle. So I think it depends on the countries, but like I mentioned, the both safe haven assets that we like is the renminbi China government bonds. And we also like the renminbi as a currency as well. We think they will benefit from the ongoing Ukraine crisis as many central banks and investors want to diversify away from US dollar or euro, as well as a long-term play on China. Right, so that is something that we can look at, investors can consider to go long on renminbi for a long-term basis. And because of the sell-off in China properties, that is one sector we think we can see a lot of good value there, but we have to be patient. So yes, it's a lot going on because we have so many things going on, but I would say in conclusion, we have a huge correction happening now. So timing-wise, valuation is attractive, but go in stages and don't put all your money in at the moment. Just be cautious and put in stages over the next few quarters, I would say.
All right. Thank you so much, Esther. Now, ladies and gentlemen, that's the end of our webinar today. We hope today's session provided everyone with valuable insights which could serve you better in your investment decisions. We also appreciate it if you can complete a survey that should pop up when you exit Zoom. This will help us improve our future events and for you to let us know what other topics you would like for us to cover. We apologize if we were not able to come back to your questions. You can approach your relationship manager to arrange for an appointment. Thank you everyone again. Take care and stay safe.